have a question. This is regarding the equity-based mutual funds. And we have seen a trend for last 3 to 5 years, these equity-based mutual fund, maximum equity-based mutual funds, they could not even beat the benchmark. 90% of the mutual fund schemes, they could not give the return. And now we have seen a trend, now people are liquidating their mutual fund investments, particularly equity-based mutual fund investments, and they have started directly investing into equities. So do you think this kind of trend is not a good sign for equity-based mutual funds?
No, India is a large country and mutual funds are growing very rapidly. And it is also true that many investors have started investing directly. Many investors who have started investing directly could be primarily attributed to the convenience, that they have. You can start a brokerage account completely online with your, if you have a phone, if you have a bank, a smartphone, an Aadhaar card, so you are good to go. And a bank account which you can access online. So you can do it with your phone itself. It has become easy. Also, information on shares or companies has also become easy. There are many service providers who are providing you, what to buy, what to sell. But I don't think it is a very healthy trend because, investing in equity is a very sophisticated thing. It requires good amount of learning. For many investors, it might be a good idea to have the time, inclination, interest, and they know what they are doing. But many other people, most of the people, I would guess, they're simply investing. And in a rising market, it is very easy to make money in equity. And you don't know what to go, what they are investing in, what is the reason, do they know the reason? Mutual fund is on a completely different thing that, it's a managed portfolio. You are able to put your money with convenience in a programmed manner. It enforces discipline. It actually gets positioned as a savings and investment vehicle. Equity by its very design and it's very volatile, and because people are buying individual stocks day in and day out more frequently, they may not have when you buy a mutual fund, you think in terms of investing regularly for 3 years, 5 years. When you think of equity, just because you just might buy those shares for many years, but you think in terms of it can be sold anytime. The impact of volatility in equity market take its toll on investors, and investors are prompted to act more often. That itself is one of the biggest, disadvantage for individual investors getting into shares directly. And that too without understanding, I think it's a very risky thing. But it will take time for people to understand. I think when people lose money in shares and now it has become convenient, that is the cost of learning.
Okay.
That said, I would like to, touch upon the first aspect that many mutual funds are not beating the index. Yes, it is true that, last 2 years, many mutual funds and particularly large cap funds have not been able to beat the index. But, look at the 10-year return of Sensex. The 10-year return of Sensex, unadjusted I'm not talking of the total return index, is about 7.6%. And when you look at the multi-cap fund category average, it's about 9-10%. When I look at the mid-cap, it's, 12%, 9%, even. So I would say that, one should not really take a view. Yes, last 2 years they have not, because, the index was, completely propelled or driven by 3-4 stocks doing exceedingly well. And mutual fund is a far more diversified. That's one. The other is in a country like India, where there are a large number of good companies spread across of different size and shape and different dimensions. I would say that, the exposure to mid and small cap or a multi-cap fund which gets you that exposure is quite meaningful. And that actually is the mutual fund promise in terms of giving you wider access. And the only index which works in India is, the Nifty and the Sensex, which is available to individual investors.
Right.